Hello, I'm Alan Kohler, Editor-at-Large of Intelligent Investor and finance presenter, columnist and podcaster for the ABC.
And I'm Stephen Mayne, contributor at Intelligent Investor, founder of Crikey and shareholder activist.
And what are we?
We are the Money Café, aren't we?
We are.
Now, I've been up since 5 o'clock watching the French get smashed by the Spanish in the World Cup semi 2-0.
2-0.
Total upset. The French were hot favourites, had smashed all before them, had the best attacking four the world has ever seen, and they were up against the best defence the world has ever seen, and the defence prevailed. The Spanish are through 2-0, and they've conceded 1 goal in 7 games. So best ever defence against best ever attack, and it's the Spaniards. Trump won't be happy, and the English are down to the last 3, and if the English can get over Argentina, it's an England-Spain final. So very excited about England-Argentina tomorrow morning. A replay of the most famous soccer game in history, the Maradona hand of God.
Oh, yeah, that's right. Is Spain going to win the tournament, do you think?
Hot favourites now. After taking out the French, absolute hot favourites. But anything can happen in a game of soccer. I mean, the French were the hot favourites today. So 2 teams, it's a game of chances, soccer. Soccer just produces more upsets because, it's such a fine line between a goal and no goal.
Not many goals are kicked, right? So if you kick a goal, you're in a good chance to win.
That's right. And then when you goal down, you start attacking too much and then you're exposed to another goal, which is sort of what happened to the French to a degree. But, best ever World Cup. It's been absolutely spectacular. I'll be, very sad in a week when it's over. But back to dreary winter in Australia. So, but we should move on from soccer. This is not a soccer podcast. So where do we start? Overnight markets, you reckon?
All happened on Wall Street last night. Firstly, IBM shares down 25%. That was the biggest fall ever. It was bigger than the fall that IBM shares suffered in the 1987 Black Monday crash. So, and it was all because they had a profit warning because of AI, and the CEO, whose name escapes me, basically said they mucked up the transition. They're mucking it up. What's his name? Arvind Krishna. We did not adapt and move quickly enough, and numerous large deals failed to close on their timelines we expected, driving the majority of our shortfall.
And that's because a lot of the clients are reallocating their spend to the AI boom. So a bit of an old mainframe type company like IBM is getting crowded out by the need to spend money elsewhere. You can only spend, your IT budget can only go so far. But this is not the SaaS apocalypse necessarily, because on the same day, we've seen all these cyber companies hitting record highs, because it's basically cyber and chips are sort of the big part of the boom. So the SK Hynix, extraordinary debut on Wall Street, the Korean chip maker. So it's winners and losers, but certainly IBM, the most storied US or global IT company, 25% in one day, it's just breathtaking. That's right.
And on the other hand, the Wall Street banks, JP Morgan, Goldman Sachs, Citigroup and Bank of America all reported their quarterlies. And it was a total, they reported combined equities trading revenue of $19.3 billion, a lot more than analysts had expected, and 72% up on a year ago. Amazing. I mean, the shares didn't all go up. I mean, I think Citigroup shares fell, but Goldman Sachs was up 8 or 9% or something.
Yeah, so it's almost tripled in 18 months now. Goldman Sachs up 9%. Market cap, it's still the market cap's only like $340 billion US dollars, even up 9%. So it's nowhere in that Nvidia 5 trillion. It's not like the big banks are nothing like big tech, but they certainly have had a big quarter, clipping the ticket on the AI boom. And I thought David Solomon, that was an interesting comment, that the boss of Goldman Sachs said that they just can't handle the demand. There is so much capital formation requests going on that they're struggling to keep up with all the different companies seeking to raise capital. That's, $85 billion in the secondaries by Alphabet, all the sort of the AI startups. So the ticket clippers are struggling to keep up with the AI tech arms race, but equally they're all making a fortune on the trading equity trading side of things. And that goes down to whether it's a bubble or not, because the ticket clippers make a lot of money in a bubble. And that's what David Solomon said, quote, "It's not a bubble, it's a trend." So AI is a trend, a massive productivity-inducing, world-changing trend, and there'll be winners and losers, like in every massive change. But it's not a bubble; it's a trend, and you got to back the winners.
JP Morgan's chief executive Jamie Dimon said it's close. It's getting close to as good as it gets. But it's worth noting that when we talk about combined the equities trading, that these companies are making nearly $20 billion in equities trading. That's not exactly trading, and it's not brokerage. It's basically they're virtually like bookies. They kind of run the books for other traders. And so basically what's going on is these banks are bookmakers in the great casino or the great race course trading of the AI boom.
It is just amazing, isn't it? And then speaking of, I do like the Americans, they're quite regular with their numbers, aren't they? Like, we obviously don't have quarterly reporting here, but even with the US deficit, they even got monthly reporting. And I did like the number this morning that came out that the US deficit was $120 billion for the month, because they did $49 billion of tariff refunds in 1 month. So they collected $166 billion in tariffs, and the Supreme Court said, no, you don't. And the whole issue of are they going to pay it back? And they've actually repaid $49 billion in 1 month to deliver the biggest ever monthly deficit, one of the biggest, $120 billion for the month, whereas in June last year, they had a $27 billion surplus, a monthly budget surplus, because they were hoofing it with the tariff revenue. So the money comes in, temporary surplus, the money goes out, record deficit. So they've still got this massive structural deficit without any tariff revenue because they're having to give it all back.
And speaking of American revenue, Donald Trump has given up the idea of putting a 20% toll or fee on ships going through the Strait of Hormuz, which he announced yesterday, and this morning has said, no, we're not going to do that now. We're going to replace that with in negotiations with all of the Gulf states, and they will invest in America. So,
one of his top 50 worst thought bubbles, you reckon, that one?
Well, it's different.
Ticket clip on a strait that you have no rights to at all. I mean, come on.
Well, I know. That's right. In order to charge a 20% fee on ships, they'd have to actually be there they'd have to have a permanent presence in the Strait of Hormuz to do it. Anyway, I think
it's a user pays argument that we're offering the security, we're spending the militaries to stop the Iranians, therefore you all must pay for us. But I don't think people are going to cop paying it direct. 20%, $150 million worth of oil going through in a cargo, and you're paying $30 million.
No, but it's a different.
$150, $160 million cargo, man, it's just ridiculous.
But it's just a different type of extortion now. I mean, they're going to invest in America. They're going to hand over cash in some other form to the United States, not pay a fee.
And the madness of the toll is, it's the precedent problem, because then the Strait of Taiwan, the Strait of Malacca, once you say, one piece of water's got a toll, then in goes China and others elsewhere. But look, oil had its 10% increase in oil yesterday. So, and they're still exchanging, they're still bombing sort of third night. So
the oil price didn't come down last night. The Brent price is still $85 a barrel. The West Texas crude is $79 still, so basically the same as it was yesterday.
So interesting, if the Albanese government, if oil keeps spiking, if they hold the line with the extra 16 cents excise tax going back on August 3, so they've got 2.5 weeks to whack the motorists with that final 16 cents of the 32 cut. So it'd be interesting to see if they hold the line with that, if the conflict continues and oil prices continue to rise. So, and speaking of energy, Alan, we've got some breaking news today, I think, with the big energy price report.
Oh, well, we'll see what happens. It's a CSIRO's what they call the Gen Cost report on renewable energy. It's complicated. I had a briefing on it yesterday from the CSIRO, and Basically, it says that in order to meet net zero by 2050, electricity prices have to go up by 50% in 2030, so in 4 years' time. I'm not sure that'll be the headlines when the report comes, when it's kind of reported on today, but it probably ought to be. It's a bit more complicated than that. Electricity, the actual 50% increase is the generation cost, but that's only a third of the total price of electricity. The rest is transmission and profit margins. And I think that it'll probably turn into a 10 or 20% increase in price by 2030. And I think that they'll fudge it and won't actually talk about it. I'll probably talk about it in this week's Week in Briefing a bit. I was going to do a column on the ABC about it, but I think there's too much else going on to do that.
Well, I read the press release, and I thought that it was interesting that the average price is down to 104 megawatt hour, and it peaked at 189 with the Ukraine invasion. So there is a message of falling prices, particularly driven by batteries and solar wind. So I sort of read it as a good story on renewables and batteries together, reducing the price, but the global cost pressures on gas because of AI. Like the demand for gas turbines globally is enormous, and so it's actually driving up the cost of delivering gas, which I guess from a cost competition point of view makes that sort of renewables push even stronger. And they're still saying they reckon we're going to get to 93% renewables, basically solar, wind, and backed by batteries by 2050. So I thought that reading just a press release anyway, that it was like we're doing pretty well, and the renewable business case is strong, and we're executing it quite well in Australia.
Yeah, that's up to now. I mean, the sort of the real story, I think, is what's going to happen in future, and how we're going to get to net zero by 2050, and it's definitely going to cost a fair bit more in terms of electricity in future. It isn't at the moment. That's true, but it will in future. So the other thing is, we probably should deal with the Telstra outage of last week. I mean, that's since we last had a Money Café. I mean, what did you think of that?
Well, it was, I kept having phone calls that dropped out after 15 minutes. That was the way I was hit. But look, I was just amazed at how one company can have a software timing glitch and it can affect the whole country. It just shows the vulnerability of the nation, a connected internet nation, to the number one infrastructure player. So it's very embarrassing for Telstra. I mean, they're going to be dragged into the Senate Star Chamber with Sarah Hanson-Young grilling them, and Vicky Brady being berated for being on holidays and all that sort of stuff. But yeah, they'll get a fine, and it's a brand damage issue. Triple O is always a catastrophe with any threats to Triple O, and people saying the government should be running Triple O. Don't trust a private company. So yeah, look. Not great. I think they've handled it sort of okay. But
I was amazed that the trains went out. The V-Line trains in Victoria went out. They just couldn't operate. Unbelievable. Everyone was stuck at the station for hours. Yeah. I suppose what it means to some extent is that if Elon Musk can actually get a global satellite phone service up and running, as he's been talking about, some people basically use it. I mean, I think that these cell-based companies with mobile phone towers using, for their phone network, might end up being in trouble if it can get replaced by satellites.
Well, you just need a backup, don't you? You just need that switcheroo. It's like the power, the energy, the generator on site when the lights go out, sort of thing. It's just. Yeah, but I'm sure there's a regulatory response to this, because you just can't have something like this happening. I mean, it's actually a bit embarrassing to the nation that you can just have such a huge impact from one company having a software glitch. So I guess they deserve a solid inquisition. But I was just a bit surprised to see you can't trust a private company, it should be nationalised. I think I'm not sure that's the solution, but. Yeah, it was a very bad week for Telstra, that's for sure.
Well, I think there is a case for for some sort of government intervention in 000, that is a service that should be provided by the government, you would think. I don't know how they do it. I mean, they haven't got mobile phone towers themselves.
How do you carve that out of the rest of the Telstra telecoms market? I mean, I don't see how you can actually do that. I think it's a heavy regulatory approach is the solution, because it's just too hard to ring fence the infrastructure to have, government owned. I mean, I guess the NBN is government owned, so okay, pop it into the NBN but I don't think necessarily who owns it is actually going to directly deliver the result, because I don't think there's a case here that Telstra's been slashing and burning brutally to maximise profits and dividends and CEO bonuses and all because they're driven by that. They've underinvested and this has led to that. It seems to be a bit more complex and nuanced than that simple narrative.
By the way, we've got a big speech by the Prime Minister, Anthony Albanese, today about AI, which I'm going to be interested to see. I mean, I think there's a fairly simple, this may be an oversimplistic interpretation of government policy on AI. The question is whether they're going to have a regime that's like pharmaceuticals, where you can't release it until it's been checked and tested. And that seems to me the issue. Either you do that or you don't do that. At the moment, the regime in Australia is voluntary, and they test it after they're testing it. They've got this thing called the AI Safety Institute, and they're testing AI, but they're already in the market. And apparently, I haven't read the speech yet, and I don't think you can read it, but the Financial Review got an early copy of it, and they've quoted him saying that pharmaceutical companies don't get to release stuff out to the market until it's been checked, and it doesn't quite say that they're going to do that for AI, but I think that's the issue.
I think it's a bit like, forcing the big four audit firms to structurally separate their audit function. It's very hard for Australia, 10th, 11th, 12th biggest economy in the world, to be a regulatory trendsetter. So it's a battle between Europe and the US, and the Europeans are obviously going harder as a collective economy of 1 billion people. They've got strength, that they matter. And at the end of the day, we're just going to be like being a price taker. We're just going to be a regulatory taker. And however far Europe pushes it with the pharmaceutical model is probably only as far as we'll be able to push it, because who are we in Australia to come up with a different or unique view about it, whether a product can be rolled out? I mean,
I know, but look, we do it with pharmaceuticals. The Therapeutic Goods Administration makes its own mind up. I mean, it doesn't take what the Europeans or the Americans regulators do with pharmaceuticals. They, you have to get through the TGA in Australia before you release your drug here. So I think it's not impossible for Australia to make its own mind up.
I just think that the drugs, medicine, it's more science-based. It's just a harder measure, because this goes to security, IT products. It's just a whole different realm to drugs that you take that affect your body. I just think it's just easier to do that regime, the testing regime, with drugs than with global IT products. So, the analogy is good, and I think Australia, the Americans are so laissez-faire, so corporately driven. The techs have been, far too under-regulated. Agree with all that. But putting the genie back in the bottle and Australia's ability to move the needle in a global debate on AI regulations, we need to be seen to be doing things. Whether we actually can do anything above and beyond what, say, the Europeans do, I think it's going to be a stretch.
Fair enough. Okay, let's go to questions.
14 questions from blokes this week, boss, so we better hear a message from our sponsor before we get into them.
Let's do that.
Picking investments, rebalancing, and keeping on top of markets can feel like a lot. InvestSmart makes it simpler with professionally managed ETF portfolios. Open and fund a new InvestSmart portfolio in July and receive a $100 bonus contribution. Visit investsmart.com.au to learn more. Remember, past performance isn't a promise of future success. Terms and conditions apply.
And before we do the questions, please be aware that this is general advice only. If you need personal advice, please go and see an advisor. You can go first, Stephen.
Now, Peter has said he's a long-term listener and fan, and he's been meaning to ask this question for years. But finally, he's had enough of James in particular for blaming workers for poor productivity. Alan points out facts that it's largely due to the lack of investment by business, not workers. And under the last decade of coalition governments with a deliberate policy of wage suppression, wage growth flatlined and went negative. And then Peter's blaming the coalition for letting house prices go through the roof, and basically saying it's time that the PAYG citizens take a well-earned break from the demands of business owners. And we're not going to take it anymore, he's basically saying, and stop blaming the workers for Australia's relatively low productivity.
It's not a question, though, is it?
No, it's more of a statement, I'd say. It sounds a bit like 1970s workers versus capital perspective. And, Peter, I'd just say that we've got the world's highest minimum wage in Australia, and unionisation rates have fallen so far that your enterprise might be able to, stick it to the bosses, but every enterprise is different. And it's quite difficult to take that sort of collectivist approach to workers of Australia are not going to take it anymore and we're going to take a well-earned break. I mean, I just don't think it works that way.
Brian says, long-time listener, but I feel a need to request that you introduce a positive segment into your podcast. Continual negative commentary on the state of the Australian economy and our government's inability to manage it has become unbearable. Oh, well, sorry, Brian. He wants us to come up with a good Australian business story that you could highlight and give a bit of kudos to. Go on, Stephen, you must have good stories.
My daughter works for Yochi, the yogurt place that Janine Ellis started, the founder of Boost Juice, and they are just booming. Every time I visit my daughter, it's people everywhere, and they're taking it overseas now. It's just, so that's for me, the Boost Yochi. Janine Ellis is a great entrepreneurial story from a girl who grew up in Knoxfield in the eastern suburbs of Melbourne.
I think Yochi's great. I love the way they do it. It's fantastic. Yeah. Well, speaking of kind of food chains, Grilled is a great story too.
I go to Grilled quite a bit. I agree. It's a great really story. But we probably should. I mean, public company. I'm flying to Sydney next week for the Macquarie AGM. I think it'll be round 13 or 14 with Macquarie. Going up to visit them on my birthday. And look, they're like Goldman Sachs. Their shares are at $253 today. The Millionaires Factory, they're worth $97 billion. They are a great Australian success story, and I'm going to really be struggling to hit them between the eyes next week when they're doing so well. And then one other company I love, Monadelphous, out there in WA. They shares have more than doubled. They're now worth $2.85 billion, and they are an Australian public listed company that delivers a whole bunch of the engineering solutions to huge projects to the big mining giants. So they work for Rio and BHP and Twiggy and Gina and in all those massive constructions out there in the desert. Monadelphous, a great Australian listed company, is a major supplier, and often companies go broke dealing with those big miners. And Monadelphous has survived for a long time, and the shares are at $28, and it's just a great Australian success story. So there you go, Brian. There's a bit of happiness. What about you, Alan?
Oh, Pro Medicus, for sure. What a great Australian success story. That is selling radiology to the Americans absolutely hand over fist. It's a magnificent product, and they're going beautifully.
Yeah, but I do agree we need some more success stories.
Yeah. Let's move on.
Anyway, we're being too negative, so let's try and keep it positive. Now, Matt says, love the pod. He says, Stephen, I agree that as a retail shareholder we get ignored and forgotten. However, the friction lies with the share registries and their lack of innovation. And I was talking about Computershare being a great Australian success story, which they are. But how can they be when their technology is archaic? Trying to log in as a shareholder is like crawling across barbed wire, let alone trying to vote or do anything useful. Solution: use your influence to get an integration with the broking platforms, where every retail shareholder has an app with notifications. If you have X holdings with a HIN or a ComSec or a stake, you can push a button to vote with the broker. They could send a text message. Everyone could log into an investing app, not navigating through 3 or 4 different share registries. Now, ironically, Matt, I actually spent a couple of hours, a couple of weeks ago, with the CEO of Computershare, Stuart Irving, who was in town. He's based in London, but he was visiting. And he made an interesting comment that all over the world, the question is, who pays for share registry services? So in Australia, it is the companies. So the BHPs, the Combanks, they pay for the share registry services. In many countries, it's the brokers. The brokers actually pay for the registry services. And he says reform comes faster in markets where it's the brokers who pay rather than the companies. But my personal comment is, the ASX itself, the sort of the monopoly ASX, is a part of the problem, and they're difficult to deal with. But I agree that we need big legislative changes to make a clunky system easier. And if I was fixing it, I would give the Australian Electoral Commission a mandate to get the voting rate up from the current rate of 2%, to do system reform that gets voting rates up. And I think that the solution that Matt came up with, where one app, all shares consolidated, can vote easily, is actually a very good suggestion. And he says, make it your next 2 years life goal. And I think that's a good suggestion. I've actually been thinking about that myself. We need system reform, because the level of voting at the moment at 2.2% is a crisis, and we have 93% voting rates in elections. We wouldn't take a 2% turnout rate in public elections, Alan, would we?
We certainly would not, no. But it's a bit easier to vote. Well, it's a law for a start. It's you have to. You get fined if you don't.
Well, I would say you only get your dividend if you vote. That'd fix things quickly, wouldn't you? That'd be borrowing from the avoid the fine philosophy in political elections.
Yeah, exactly. That's right. But you're right. It needs to be made easier. And I think that the suggestion from Matt, is it Matt? Yeah. The suggestion from Matt is a good one. I agree.
Yeah. Absolutely.
Kai says, in the US, communities are increasingly pushing back against AI data centres because their immense power demands are driving up local electricity prices. However, when built in regions with massive electricity generation surpluses, these facilities present powerful win-win. Consider two prime examples. In Nordic region, hyperscalers like Microsoft are capitalising on the region's massive cheap hydropower surplus. In South Australia, this region regularly generates far more rooftop and utility solar than its entire local population can consume during peak daylight hours. Establishing liquid-cooled AI data centres here allows companies to absorb the vast low-cost midday energy surplus, stabilising the local power grid. By matching high-density AI clusters with localised energy gluts, tech companies slash operational costs while actively supporting community energy infrastructure. So I think that's true, and it's one of the threshold things I think that should be a part of the regulation of AI, which is that you only get approval to build a data centre if you're going to either build your own power generation or have a letter from the local power generator that's not you saying they have a surplus to the extent of to a greater extent than your demand is going to be. And I reckon that's what should happen.
I agree with that. It is, I mean, Kai's right, but it's quite difficult to just say put the data centres where there are surpluses, because you also need to have the data centres, near the big cities where the compute requests are coming from. Otherwise, you've got the classic, huge transmission lines dilemma. But, a cluster of data centres in the Hunter Valley and the Latrobe Valley, which is our traditional centres. But the problem with that is you're then saying you're hooking it to fossil fuels, which we're all trying to get away from. So
yeah, but so they just should be required to build their own transmission, like whatever it might be, solar or whatever. Put some wind towers above. I mean, honestly.
Yeah, but transmission, it's one of those ones where it is a natural sort of government monopoly. I know some of them around the country have been privatised, but it is a natural monopoly. And once you got private operators building their own transmission lines, I mean, they do have to integrate with the government-owned. It's like putting toll roads into the public road system. It's not great, is it? You get Transurban distorting decisions because they've got a private monopoly. So, yeah, but look, I think I think the solution will end up in space. I think that a lot of people say that, and I think the logic of just hanging a data center above the city and beaming it down using the sun. I mean, there's a logic in that, isn't there?
There is.
Clancy says, enjoy your pod. And he says, it seems inconsistent to champion retail investor access to IPOs and capital raises generally, but call it a problem when Elon Musk pushes for more retail participation specifically. Now, well, Clancy, I didn't really say it was a problem that Musk... Well, I did say that I was worried that Musk was just being a spruiker trying to attract dumb retail money or unsophisticated retail money, because he came out and said, I want to get 30%. And I think that he's been the number one spruiker in the world selling a dream to unsophisticated punters. And I was surprised that ASIC gave him approval for his prospectus. But look, in terms of retail treatment, my issue is more, in secondary raises by existing listed companies where they do a big end of town placement and don't give retail a chance to participate. So it's slightly different, my big thing. And look, I did say with Musk that I thought it was in light of the fact that the shares were booming, or likely to boom, that it was a bit rough of him to say we're going to give 30% to retail, and then in the end he only gave 20% to retail. And people like Gina Reinhardt jumped to the front of the queue and got $1 billion allotment, when all the 30,000 ComSec customers, including myself who applied, got scaled by 60%. So we got scaled, and the insiders jumped to the front of the queue. So I thought that was a bit rough as well. But SpaceX shares are back down to near the float price, Alan, so we might yet prove to be correct in saying it was an overhyped meme stock.
I think we can confidently assert that you were correct.
Well, it needs to. I've said it'll be below 100 by Christmas. So I think when it's 25% underwater, that's when I think the inquisitions on ASIC, ComSec and others will be fair enough. But you've always got to be flexible with these things. The scoreboard, if it stays high, then you can't complain. But I'll be surprised because the thing's burning cash like nothing else.
I note that SpaceX's Grok, which used to be just XAI, has just released a new model that is claimed to be as good as Claude's Fable or something. So they're obviously in there competing or trying to. And the other thing is that SpaceX owns the Starlink satellite internet business, which is a good business. And we just were recently talking about how they're going to move to phones eventually, as well as internet supply. So maybe eventually they'll make a lot of money from having a global satellite phone business. Maybe.
Well, I've already got a great global business in Starlink, and if it was only that, it would be fine. But this whole sort of decision to compete in AI, I think that he's going to be one of the losers. There's going to be winners and losers.
Yeah.
And did you see the Twitter spat over the weekend where Musk was ripping into Sam Altman? So after Apple sued OpenAI for stealing the software or their IP, Musk has gone in, you're always stealing, you stole AI, and now you're stealing off Apple, you're a crook, and Altman's firing back. Boys, settle down. Just, whew. But the stakes are high and the personalities are big, it's fair to say, in the AI space.
Alex says, greetings from Dubai. G'day, Alex. With the US national debt now at approximately $39.2 trillion and continuing to rise rapidly, what are the most likely long-term outcomes? What are the best case, worst case, and most probable scenarios over the coming decades? Well, go ahead, Stephen.
Well, I think it'll never be paid back, and that one day, because there's all this debt in the world that will never be paid back, but it's all owed to each other. It's not owed to people on Mars. So it doesn't have to be paid back. It's just an accounting treatment. So I think that one day there will be a coordinated debt write-down by the governments of the world, and in conjunction with the world's biggest money printing exercise to effectively pay back the money with the stroke of a pen, because the debts are just too large. And whenever, since the GFC and COVID, the solution whenever there's been a crisis has just been endless money printing. And endless money printing means that at some stage it's never going to be paid back, and at some stage there will need to be endless money cancelling because it just won't be paid back.
I think that's fair enough, except they're all different levels. It's not as if it's the same amount.
Getting the agreement would be the hard part. The global settlement of the accounting treatment of the great big debt write-down. That's going to be the biggest negotiation in history globally.
Well, that's right. But they can't.
Hence, it'll probably never get done because how can everyone agree?
Well, that's it, because, I think the US has got the most, but China's got a lot, Japan's got a lot. Other countries have got a lot. That's a large number in terms of the size of their own economy and percentage of GDP terms, but it's not as large as the US in dollar terms. And so if they all write it off, different countries will get different benefits from it. I can't see that happening. But you're right. Yeah. I mean, there's no way they're going to pay it back.
No, but it does highlight that the US hegemony, ultimately having the world's reserve currency, it's the ultimate power. As long as the world is running on US dollars, then they can have as much debt as they like. They can print as much as they like because they're just so in the plumbing of the global financial system that you can't hold them to account. That said, US 10-year bond yields have hit 4.6% now. So they're spiking. So that says it's mainly driven by inflation fears, but that also goes to credit worthiness and supply.
Also, the cost of paying the interest is becoming a very large part of the budget. Yeah,
that's right. So they're in, as I said, $120 billion deficit in 1 month with the tariff refund. So there are limits, and other countries have discovered the limits. I mean, there's been so many. The Brits are scarred by the Liz Truss bond route. So any country down from the US can have a bond vigilante moment. And it was the bond markets that actually took Trump to task on the tariffs, wasn't it? When he was going crazy with the tariffs initially, it was the yips in the bond market that finally got him to retreat.
Peter says, I've appreciated the balanced reporting by Alan on AI in the past couple of weeks. Thank you, Peter. In moral hazard, media companies are claiming they need revenue from gambling ads to stay solvent, while sports codes are bragging about the biggest TV rights deals in history. Why are our kids having to wear the cost of poor commercial decision-making? Yes.
Well, look, it is interesting that the NRL have done a 7-year deal worth $5 billion. So Nine is paying $145 million a year and Foxtel a bit over $500 million a year. When these contracts get inked, it's these sort of contracts that bake in the gambling, because whenever you then have a political debate about winding back gambling, you get told that the codes are going to go broke or the free-to-air or the media companies are going to go broke. I mean, I'm still connected with the anti-gambling movement, and the whole argument that's being run in Canberra is Channel 10 and Channel 7 will go broke if we ban gambling ads. And look, their business models are challenged. But I guess if you keep doing these sort of contracts, I mean, the contracts that need to be reduced are the player payments and the broadcast rights, because 20 to 30% of it is propped up by gambling. So if you've actually got to go to the heart of the economics and say, AFL players don't need $500,000 a year; they can get by on $400,000 a year, and same with the NRL players. These contracts are too rich; they're very gambling dependent. There's a lot of gambling tied up in that 7-year, $5 billion deal. And there's an interesting question, actually, is who carries the risk if the government does actually ban gambling ads? Is it the media companies or is it the NRL? I know that
it doesn't mean that the government cannot ban gambling ads.
No. But if the government was to ban it, who carries the risk? Like, is there clauses in the agreement that say, okay, Nine will only now pay $100 million a year because we've lost our $45 million in gambling ads? So within the contract between the NRL and the media companies, if there's a change of law on gambling ads, who carries the risk? And that over the years, that has switched between different sides. It's always a part of the negotiation because it is one of the largest regulatory risks that these long-term contracts have, because gambling is so at the heart of the economics of professional sport and media in Australia, which is such a tragedy because it means we're the world's biggest gamblers in the world.
Do we know whether there's a clause in the agreements to that effect about that?
Look, I haven't invested. I know that with the AFL, the last two deals it has switched from one to the other, so it is a regular debate, and it's an open. But I haven't investigated as to where the risk lies this time. Normally, it would sit with the media companies. You're taking a risk. You're offering to buy our content, and it's got to be an unconditional offer. But geez, you wouldn't want to be a media company going in and offering that sort of money, like Foxtel offering $500 million a year, and then all of a sudden you can't take gambling ads. I mean, the Murdochs sold Foxtel. The business was so bad. Dazin bought it, run by a Ukrainian billionaire. So the Ukrainian billionaire is on the hook paying $500 million a year to the NRL for every game every week for 7 years. He's certainly hoping that the gambling ads continue, that's for sure.
We're running out of time, so I think we should jump to someone called Anthropomorphic Capitalist, which is an unusual Christian name, Mr.
Yes.
Capitalist. Anyway, my contention is that China materially reduced the oil price shock by cutting crude imports by around 4.5 million barrels per day by drawing on domestic inventories rather than competing in the spot market. This 4% global oil reduction would have offset at least a third of peak supply disruption. I mean, I think this is true, and the question is why. Hang on, what does he say? China was not the sole stabilising force. Why? I would have thought that allowing oil prices to surge above $200 per barrel and the resulting political damage to Trump would overline neatly with the CCP's broader strategic ambition. So he says, I don't get it. What am I missing? And I think what you're missing is that China would also be damaged by $200 oil. Let's face it. I mean, they and it isn't true that everyone understands how they did it, because their domestic inventories don't seem to have been run down that much. So it's a bit of a mystery how they did reduce their imports by 4.5 million barrels a day. But it is true.
What, a shadow Russian cargoes, you reckon, there, sort of not recorded? But I agree, it is a puzzle. But they've massively reduced their demand, and they did have massive strategic reserves, which did help. I mean, it was a great buffer to have because they're highly dependent on oil.
Yeah.
But it's not the Chinese way to go around gloating. I mean, they don't do, Trump-style truth social saying, hey, we saved the world because, we could have bought this much and we didn't. It's just they're much more understated and...
But also it means that the question of what happens to the oil from here doesn't just depend on whether the Strait of Hormuz is open or closed. It also depends on what China does from here. And do they go back to importing 10 million barrels a day of oil, or do they stick with 6 to 7 million barrels a day? I mean, because and if they do go back, that'll actually have more of an impact on global oil prices, than the open or closure of the Strait of Hormuz.
And what's actually been interesting is that with this latest it's closed again thing, a lot of cargoes got through in the period that it was open. So there's a stack of Iranian cargoes on the water at the moment. So you can actually afford, you can afford to have the Strait of Hormuz have these sort of, these brief weekly shutdowns. What you can't do is cop a 6-month shutdown with just a total choke point. So opening and closing is not the end of the world, because when it does open, boom, out they all go. Although not many go back in because you get the uncertainty of whether you can get out again. But it is interesting, and I think there's also a point here about the reducing energy intensity of the global economy and the ability of people to pivot. More pipelines.
Well, in fact, I saw a graph. I saw a map this morning of the Middle East showing all of the new pipelines either under construction or proposed, so that the Middle East oil producers could avoid the Strait of Hormuz, and they're all over the place. This is spaghetti of new pipelines that are proposed going to either the Red Sea or the Mediterranean or the Gulf of Oman, which is on the other side of the Strait of Hormuz. So they're all busily trying to make sure they don't have to take their oil through the Strait of Hormuz in future.
Yeah, it's like can mankind fix the climate change battle? Never underestimate human ingenuity in a crisis. I mean, look at the response by the Ukrainians. Look at, and I agree, the Strait of Hormuz is closed. It's a disaster for the world. The world innovates. It pivots. It's driven by dollars and strategic, and the best brains in the world and all the commercial incentives in the world look for solutions. And the world pivoted quite well, and all that pipeline construction is a good example of that. So people are flexible. So and let's finish with Robert, because I think it's an interesting point. Robert's basically given an example of how he was with Buddy Telco for his broadband, and then he went over to Tangerine, and he tells the story of basically, I changed brands and then I got an offer to come back. And his basic point is that it's an absolute waste of everybody's time to change your service provider and then get an offer to come back. And the point that I think needs to be made is that the prizes in this life go to the people who suffer the most are the inert customers who do nothing. and you have to shop around. Certainly in some markets. I mean, I subscribe to many newspaper services, even the West Australian, New Zealand. From time to time, I go, this is costing me too much, and I threaten to cancel, and I get a 3-month discount. So I could do that, 3 hours a day, Alan, and I'd be saving a couple of $1,000s a year. I'd be constantly cancelling. But why can't I just get a good deal all the time? Why can't I just get rewarded? Why don't any of these companies ever say, you've been a customer for 10 years, we're going to cut your price by 10% because your loyalty is so fantastic? All the benefit goes to the new customers, and it causes this massive amount of churn. And unless you shop around, you lose out.
Well, it's because these companies rely on the inertia tax.
It is.
Or the loyalty tax.
Absolutely right. The
They do.
inertia tax. It is a huge thing. So if you've been sitting there with a Commonwealth Bank customer or a Foxtel customer for 20 years and you've never actually rung up and asked for anything, you are a highly profitable inert customer.
Yeah, well, I'm a big payer of inertia taxes.
Oh, so am I.
Because I sit there doing nothing all the time because I'm too busy.
It's too much. It's a waste of
I'm
your time.
inert.
I mean,
Well,
who wants to haggle? It's unpleasant. And you're lying too. You ring up and you're lying. Oh, I'm going on holidays. I'm cancelling. You're not really. You're forced to lie to get a good deal. I don't like doing that either.
I love haggling, but I'm not. I just haven't. I'm too busy. I can't do it, so I'm paying all this inertia tax. Yeah. Anyway,
this is what the finance department should be doing for us. But when you work for yourself, Alan, you're your own finance department. You can't get HR or anyone to help out. You've got to do it all yourself.
That's right. Thanks everyone for listening to today's episode of the Money Café. Stephen and James will be steering the ship together the next 2 weeks while I take a break. So send in your question. And Stephen, what day is next week is your birthday? Will it be the Money Café day or is it Tuesday?
I haven't checked yet. Thursday, I think it is,
Thursday,
the 23rd. No, it's not Money Café day because I'll be flying to Sydney on the 6 o'clock, harassing Macquarie for the day. How do you attack a fantastic company? Not easy. And then flying back for a nice family dinner that night. So, but I'm looking forward to talking to James, the greatest breaking news commentator in the land. Always a pleasure talking to him. And you have a nice break. Have you been invited to the World Cup final or something? So you got some
No, I'm just going to do nothing for 2 weeks.
Winter, recharge those batteries.
Correct. Send in your question for Stephen and James to the Money Café at intelligentinvestor.com.au. And so I'll be back in 3 weeks' time. Until then, I'm Alan Kohler, Editor-at-Large of Intelligent Investor, finance presenter, columnist and podcaster for the ABC.
And I'm Stephen Mayne, and we'll see you next week.